It's the 16th of July, and you're listening to Kopi Time, a podcast series on markets and economies from DBS Group Research here in Singapore. I'm Taimur Beg, Chief Economist, welcoming you to our 22nd episode. Our guest today is Dr. Khor Hoe Ee, Chief Economist of AMRO. If you expand that, that would be ASEAN+3 Macroeconomic Research Office. A veteran economist and central banker, Dr. Khor began his career in 1981 at the IMF. He was there on various capacities all the way till 1996, after which he came back to his native Singapore to join MAS, the Monetary Authority of Singapore. There, Dr. Khor served as the Assistant Managing Director from 2001 to 2009. And then he went back to the IMF, stayed till 2016, at which point he returned to Singapore as the current avatar of Chief Economist AMRO. Dr. Khor, welcome to Kopi Time.
Thank you, Taimur, for inviting me to this podcast.
It's our pleasure. We will begin with the genesis of AMRO. I understand it was set up about a decade or so ago. Walk us through who and for what purposes did AMRO get set up?
Yeah, so it was set up in 2009 after the global financial crisis. Basically, the finance minister of the ASEAN+3 countries, meaning the 10 ASEAN countries together with China, Japan, and Korea, agreed to establish an independent regional surveillance unit, right, to promote objective economic surveillance. So in 2011, it was formally established as a company in Singapore, and then it became an international organization in 2016. So as I mentioned, the objective of the AMRO is basically to conduct macroeconomic surveillance of the countries in the region, and also to support the CMIM, which is the Chiang Mai Initiative multilateralization. This is a financing facility that was set up to provide financing support to the countries in the region in case they get hit by liquidity shocks.
Very good. Dr. Khor, in this region, including in Singapore, we have various other multilateral organizations ranging from the IMF to ADB, as well as the World Bank and this CSEN based in Kuala Lumpur. Some of them are engaged in providing financing and guarantees. Some of them are engaged in capacity building, and the others do carry out advice to country authorities. Help us understand how AMRO is differentiated.
Well, let me start with the World Bank and the ADB. Those are multilateral development banks. So they basically provide financing for projects, right? They do research, but they don't really conduct surveillance of countries. Then you have the CSEN, which is a training center set up by the regional central bank to provide training to the staff. So again, it's quite different. They don't do surveillance. The one that's most similar to AMRO would be the IMF regional office, which they have an office here in Singapore, but which conducts surveillance on Singapore and Malaysia. But IMF, the headquarters is in DC, and they are a global organization with 189 member countries, and their mandate is much broader, which is basically to safeguard the stability of the international monetary system. Here, our mandate is much more narrow, it's more regional. We are supposed to promote financial stability within the region by conducting macroeconomic surveillance.
Very good, makes sense. Since surveillance is at the core of your business, so let's start there in terms of our deep dive into the regional outlook. Share with us your regional macroeconomic views. I will not ask you to go through the slog of every single member country that you have, but perhaps if we could touch on the pandemic response and protecting livelihoods that has been carried out by China, Indonesia, Singapore, and Vietnam.
Yeah, okay, so let me start with the region as a whole, right? It's a very diverse group of countries, ranging from advanced economy to emerging markets and then to developing countries. So you can expect that the performance in terms of dealing with the pandemic would vary across the region. But by and large, the region has been done really well, I think, in containing the infection. So the total number of cases in the region is over 300,000 compared with a global total of 13.3 million, right? And the death toll has been quite low also in the region. And within the region, most of the countries have already emerged from the lockdown, pretty much. But some countries are still struggling to flatten the curve, so-called, and contain the infection rate. Those two are Indonesia and the Philippines, right? You mentioned those four countries. They're very diverse. China, as we all know, is the first one that got hit by the infection, and they have done a spectacular job in containing the infection. There have been outbreaks here and there, but pretty much it's under control. And so because of that, they've been able to open up much more fully, and already I think production has bounced back above the pre-COVID level, right? Except for services sector, which is still struggling a bit, but in the goods segment, manufacturing in particular, growth has been bounced back up. And just this today, I think they announced the GDP growth for China of 3.2%, which is well above expectation. Singapore, and because of that, they have not had to enact pretty large stimulus package to support the economy. Obviously, they have recently come up and provide support for the SME sector, and also they realize the external demand might be a bit weak, so they have also decided to provide more infrastructure financing to stimulate domestic demand. But it's pretty modest, the economic package that they have come up with. Singapore, as you know, was hit by a second wave. And unfortunately, Singapore has a very large foreign workers population. And because of that, and the foreign workers live in dormitories, and they are very close to have physical distancing. So once they get the dormitories get infected, it's very hard to contain it. So as a result, the infection rate, it's very high for a long period of time, and Singapore had to lock down the economy a second time, and it was very costly. But they locked down all the dormitories to prevent the virus from spreading beyond the dormitories to infect the rest of the community, and that has been quite successful. So they bring down the infection rate now to the low double digit. Usually it's between 10 to 20 a day. Some days it's in the single digit. So Singapore has also started to open up, but the dormitories will take a little bit more time to open up. But this long lockdown period has been very costly for Singapore, and they had a stimulus package of almost 20% of GDP. But fortunately for Singapore, they have a lot of fiscal savings built up over the years, and they're able to draw down the fiscal savings to finance the deficit. Indonesia, I just mentioned, still struggling to bring the infection rate down, but it's a sprawling archipelago, and maybe that's why it's harder to contain the infection. But they are also struggling, and they started opening up. And so in Jakarta, they seem to have brought the inflation, flattened the curve. The infection rate is slowly coming down, but other parts of Indonesia, are still quite high. But even so, I think the total number is quite low if you compare to other big countries in the world. So we are hopeful that in a few more weeks, we begin to see the infection rate coming down for Indonesia. But Indonesia has also enacted a relatively large stimulus package to support the economy through this difficult period. And they have had to bust their fiscal rule. As you know, they try to cap their fiscal deficit below 3% a year. But because of the pandemic and the need to support businesses and workers and households, they expect the fiscal deficit this year will increase to about over 6%, right? But so far, because of the pandemic and the collapse in demand, the current account has actually deficit has turned smaller. So that has given them some space. The currency is relatively stable. and inflation is low. And so they've been able to finance the fiscal deficit so far without any problem. And Vietnam, I think, is one of the most successful country in terms of containing the infection. They kept it to just below 370 cases and no death. And because they've been so successful, they haven't had to enact very large stimulus package to support the economy. And it's one of the few economies that we expect will have positive growth this year. In fact, we expect growth this year to be above 3%. So, the experience has been quite diverse across the region.
Indeed. And I think I have to sort of underscore 2 points that you made that I share wholeheartedly, but both points I think that there is still not proper appreciation in the markets or also among the analyst community. The first one is that the struggle of Indonesia and Philippines, despite fairly assertive, proactive measures of the authorities, shows that we really don't understand the nature of the infection fully. Anybody who tells you that is being fairly optimistic, and every day we see new developments and puzzles for epidemiologists and public health officials about the nature of the spread and the nature of the disease. For a while, we believed that in hot countries, it will not be a big deal. It's actually a pretty big deal. For a while, we thought that this would only affect the elderly, but it turns out the mortality may be less among the young, but they could be affected quite deeply, even if they don't die by this. And also the notion of spread, where the conventional wisdom is it's through droplets, but now I see more and more studies showing that even aerosol spray, just the mere act of breathing could lead to spread, which of course makes it very difficult. And of course, Dr. Khor, as you pointed out, that these sprawling countries like Indonesia, Philippines, by geographical design, make it more difficult. Some region may be under control and others are not. Short of stopping people from moving from one region to the other, you can't really control it, which is the same problem that the US has, Brazil has, and India also has, right? And the other point that you mentioned, in Singapore's case, the migrant worker situation, the last few days, reading the stories of the US, looking at the pandemic spreading among the agricultural workers and the migrant workers in Florida and Arizona, I'm sort of reminded of the exact same dynamic, that whenever you have a worker community living in close quarters, it doesn't really matter whether it's Singapore or the US, the outbreak becomes difficult to contain. Great. I wanted to ask one overarching question about your sort of the staff forecast right now. Are you comfortable with your latest published forecast, or do you fear that they're characterized by further downside risks?
Well, we revised our latest forecast just about a month ago. And I think our baseline scenario is pretty realistic. We assume a relatively severe recession in the US and Europe. And basically, we assume that the US-China trade tension will remain elevated and maybe, get a bit worse. On the other hand, we are not assuming any second wave, and we know that's a risk, right? Because as we just discussed, we don't really understand the virus well enough, and we still keep seeing second outbreaks, episodic perhaps, but this outbreak can develop into a second wave if we don't take care of it. So based on those assumptions, we are forecasting that the region will suffer a sharp decline in growth rate, but it will still be slightly positive, but that's mainly because of China, and as I mentioned earlier, China has already, bounced back up again. The question is how strong the growth will be this year. Our forecast for China is that it will grow by 2.3% this year, but 8 of our 14 economies will be suffering negative growth. So, it's pretty diverse. As I mentioned earlier, Vietnam is one of the few that will also have positive growth. In fact, 3.2 is the highest that we have for the region. But we are concerned about, this second wave, and also, other risks such as a relapse in the global economy, and a further escalation of the US-China trade tension, which doesn't seem to be getting any better. And then, of course, the very large, fiscal package will mean that indebtedness will increase in the public sector, and there will be damage to the balance sheet of the corporate sector and businesses. And it's still not very clear how quickly they'll be able to repair the balance sheet and emerge out of that. That could be another drag on growth that's not fully factored into our forecast.
But when you have your dialogue with regional country authorities, do you warn them about the perils of debt, or for the time being, it's okay, go out and run deficits and we'll worry about debt consolidation 2-3 years down the road?
We were actually quite worried when the thing hit, and we know that the countries have to, have much bigger stimulus package to support the economy, whether they will be able to finance it or not. But as it turns out, so far they have done well. As I mentioned, in the initial stage there was a big outflow of capital in the region, and some countries came under pressure. But then, since then, market has stabilized pretty much. The currency have appreciated, the bond yield have come down. So far up to now, financing has not been an issue, especially for the emerging markets like Indonesia and Philippines and Malaysia. And I think provided this signal to the market that once the pandemic is over, they're going to revert back to the former fiscal discipline, consolidate the budget again. I think that they should be okay. Then on the banking side, we know that most of the banks are pretty well capitalized, right? There has been this forbearance by the regulators because they realize that many businesses will not be able to repay the debt. So there's a debt moratorium, in many countries. So we know the balance sheet needs to be fixed, and some banks may need to be recapped and all that. But I think that's something that we think is manageable, but we don't really have a good view right now of how big the damage is or how big or the problem is until probably in the next few months after we come out of this.
I want to stay on this issue for just a little longer. Dr. Khor, you and I both have spent significant parts of our career in the IMF. And at least the days that you and I were there, we always advised country authorities not to monetize debt, keep the central bank's operations separate from the central governments. But in this pandemic, starting with the West, but that notion seems to be spreading worldwide, is that far deeper coordination between fiscal and monetary authorities to take care of these big issuances. Where do you stand as an economist on this issue?
Well, I think the world has changed to some extent. We used to worry also a lot about inflation, right? And inflation has simply disappeared after the Great Moderation. And countries are struggling to get inflation back up again. I think it's, at least for the advanced economy, that seems to be the default. With very low inflation and deflation environment, and so because of that, they've been able to increase the balance sheet of the central bank, without seemingly without any cost, right? For the emerging markets, I'm not so sure, right? I think they are still subject to this budget constraint. I think that as I mentioned earlier, because of the pandemic, the macro situation has changed because there's been a collapse in demand. And so as a result, the external position actually improved for most of the countries in the region. And also inflation has come down. And so that allows them to borrow a lot more than they would otherwise have been able to under normal times. But that's a situation we want to get out of, right? We want the economy to recover. We want demand to go back up. And when that happens, I think the usual constraint will kick in again, and they have to show and demonstrate to the market that they are fiscally prudent, and the balance sheets are strong. So I think that we are in a transition now to this normalized environment.
But Dr. Khor, even in this rather abnormal, extraordinary circumstances, we saw deep volatility for emerging market assets in the months of February, March, April. After that, the big fiscal monetary bazooka in the West and followed by fiscal monetary response in this part of the world, we have seen major return of animal spirits, and capital flows have come back to the region in a very big way.
Mm-hmm.
Now, spreads haven't compressed as much as they have in the West, but they've compressed substantially. Are you worried about financial market instability, that a bit too much money and too much optimism in the financial markets, which is divorced from the economic reality?
Well, not in the region. In the region, I think financial market have stabilized. They have not fully recovered, right? Except for in the case of China, right? In the last few weeks, the markets have really gone through the roof. But I think the disconnect between market and the real economy is more in the US and in the Western country, Europe, and that's because the liquidity, by the central bank is helping to show up the markets. Here, I think the financial system is still pretty much bank-based. There have been some liquidity issues for some countries like Korea and Thailand, and the central bank have stepped in to inject liquidity to make sure that the market continues to function in an orderly manner. But I don't see the big disconnect here in the region between the market and the real economy. I mean, my concern is that this capital flow volatility will come back again after we get out of this pandemic situation, and they're going to be looking at the balance sheet and of the corporate and also of the government pretty closely, and then you may get the usual volatility shocks again.
Absolutely, no, I share your concern wholeheartedly. We can spend much more time talking about the very current conjuncture, but that's not all AMRO does. You are looking at important research questions that involve also the medium term. You've built a solid research team over the years, and I've noticed a number of interesting analytical notes on your websites. Would you like to showcase a couple of things that have come out recently from your research team?
Well, we did a study on the credit contagion risk, right? Actually, as I mentioned earlier on, we are concerned about the financial distress in the corporate sector and in the banking system once we come out of this pandemic. And we want to basically highlight the importance that policymakers must take to address the situation. So in this study that we did, we basically look at the risk of contagion, not just from the bank to its immediate creditor, other banks that in the wholesale market, but also because the banks are all interconnected, that a risk in one bank can be magnified by the interconnectedness of the system, and that becomes a systemic risk. So banks are not just connected to other banks directly, but also indirectly, through these other banks, and also through market perception, and so it's sort of a captured in our study by the risk to default ratio, and so we are able to show that if there's an increase in the default risk for one bank, this risk can be magnified across the system. So it is just to emphasize to the regulators that we shouldn't take look at the individual banks, but also look at the system as a whole.
Right. And I think countries like China, this is a very big question. Although right now the financial sector does not look under considerable amount of stress, we still have the debt overhang issue. We have a structural slowdown, independent of the immediate cycle, and how that weighs into credit quality and credit risk is certainly going to be a question that both you and I have to worry about for years to come.
Indeed.
Coming back to the region and the crisis response, you have already mentioned that there's probably no free lunch like the way it is maybe for the U.S. because they have the privilege of printing U.S. dollars. There's a little tighter budget constraint for the region here, but still, should you, given the severity of the crisis, should the regional economies spend more? And if they have to, I mean, would you advise them in some specific areas they should spend? And then, of course, the question then immediately leads to, how would they finance those additional spending?
Yeah, I think this is a big challenge to many of the policymakers here. Obviously, the capacity to spend varies across the country, and many, especially developing and even the emerging market economy, they probably could have spent more to support the economy if they had the capacity. So, but already, I think they're by instinct quite cautious about overspending. But after when they get now they're in the recovery phase and they need to pull back some of the spending, especially. But if they do it too precipitously, it could cause the economy to go into a downturn again. So how you manage the exit from this stimulus package, right, is quite important because if the economy is recovering very strongly, you can probably pull back much faster. But at the same time, you also want to be able to support some sectors of the economy because we know in the new normal that certain sectors are not going to be viable, or certain companies and firms, and they have to let them go, right? And that's going to be very painful. On the other hand, we know that in the new economy, the digital uh, economy, e-commerce are going to be much more important, and you want to be able to spend more money to support those industries. So it's going to be quite challenging for policymakers going forward. I wouldn't say that they should. When I say they need to go back and display fiscal discipline, they need to also reprioritize the way they spend money to support industries which are going to do well in the new normal, and at the same time, maybe provide some support to those that has to restructure. And even in the labor market, it's not very clear that a lot of the unemployed workers will be able to get back to work again. So I think it's going to be quite challenging going forward for those policymakers. And in terms of the financing, well, it's tough, right? But I think on balance, I would say that they need to scale back the kind of fiscal deficit that they had this year to one that's more manageable. And if they signal to the market strongly their commitment to fiscal discipline, I think they should be fine. So they have to try to reprioritize and maybe end up with a somewhat bigger fiscal package than they otherwise would have.
Moving from fiscal to external, back in the days, I mean, from the taper tantrum in 2013-14 to going back to the Asian crisis in 97, we've always worried about reserve adequacy in the region, the capital flow volatility when there is a risk of in the global market environment. Do you worry about the external risks, and do we have sufficient buffers in the region, or do we need Chiang Mai +3 to take care of that?
We always worry about the external risk. And that's the reason why the Chiang Mai Initiative was set up. But I think the most of the countries in the region have always been worried about the external risk, and they have built up a significant reserve, right? If you look at the level of reserve held by most of the countries in the region, they are actually quite substantial, quite adequate in terms of months of imports. I think the average for the region, if I remember correctly, is about 6-7 months. And then in terms of coverage of short-term debt, they are more than a year. Some of them are 2-3 years in the case of the Philippines. And in terms of the IMF adequacy ratio, they also range between 120 for some of them, and more than close to 200 for some of the others. So overall, I think the reserve that accumulated over the years have been quite ample, actually, for some countries, and even for those which are a bit vulnerable, by the IMF metrics is adequate, right? But we know that in the tantrum, the shorts can be even quite large, even though you have an adequate reserve. So that's why we have a second line of defense, the Chiang Mai Initiative, CMIM, which is supposed to provide additional buffer to those countries which are vulnerable to a shock, right? But so far during this pandemic, they've been able to manage this volatility quite well. But the facility is still there, and it's, I think, comforting to know that you can rely on the facility if you need to, in the event that you have a really big shock that hits you.
You saw a few months ago when the dollar funding crunch was taking place worldwide, the Federal Reserve came up with that FEMA facility, which allowed any central bank that had an account with the Fed in New York could carry out a bit of a repo operation. So not exactly a swap. It was more expensive than a typical swap agreement, but the countries did have some access to some cheap funding. So clearly, the need for dollar funding at times of stress has not gone away. Although you could argue that the best facility is the one that does not need to be tapped because the mere existence of that is sufficient to allay market expectations and concerns. So what's your sense that the impact of CMIM has had a galvanizing impact on markets' perception on the buffers available in Asia?
Well, the CMIM is, as I said, a regional facility, right? The swap line that the Fed provides is a US dollar facility, and is much, and because of the nature of the swap and the repo, the FEMA, right, is available without on request, basically, right? As long as you have the treasury bills to repo, right, you get the liquidity immediately. So that's the advantage that they have. With the CMIM and other facilities, because they are swap lines and all that, there will always be, trying to set it up will always take a bit more time. But in the case of the Chiang Mai Initiative, it's supposed to be a quick dispersing facility that can be arranged within a short period of time, 2 weeks actually, about that. But as I said, this is an additional line of credit, and I think I can see countries in the region becoming much more secure, much more comfortable over time in managing the external vulnerability that they see the CMIM really as a second line of defense, and they will only resort to it if the need arises. Yeah, but it's comforting to have it there.
Right. I mean, there is nothing wrong with having a wide range of insurance options. Over the last decade, we have seen expansion of CMIM. We have seen bilateral swap lines being set up between PBOC and various ASEAN countries. And of course, we have the Fed twice in the last 12 years taken a fairly strong role in providing dollar liquidity. So yes, as long as dollar remains king in the world of currencies, I think the need for dollar funding will remain, and dollar assets and liabilities will be issued and traded in our part of the world as much as they have been in the past. Dr. Khor, I want to ask you two questions. One is, I think there was this recent announcement about the CMIM amendment, which I understand probably made the facilities a little more flexible. So if you could touch on that, and after that, I want to ask you longer term question about regional reliance on trade and tourism. But I'll hold that question first. Just address the issue of the 23rd of June amendment.
Yeah, so this is something that we've been working on for some time. As I mentioned earlier, the facility was set up in 2011, right? When the Chiang Mai Initiative, which is a network of bilateral swap, was multilateralized. And then they increased the size of the facility to 120 billion at that time. And then in 2014, they doubled it to 240 billion, right? And they also increased the link portion to 30% at that time. So, but so in the last since then, we've been doing a lot of test run, to try to make sure that the facility is operationally ready, so that when if a country wants to access it, it's immediate. Because it's a pretty complex arrangement with 14 central banks having bilateral swap, and we need to basically work out the operational manual, the SOP, and so that's what we've been doing over the last several years. There was also a precautionary line that was set up in 2014, and that's similar to the SCL and the PLL in the IMF, where basically, a country has to have sound macro fundamentals, then they can approach, to have a line of credit, and without conditionality. Again, it's a new facility, and we need to work out, the modus operandum to see how it works and all that. So all that was done in the last few years, and this amendment that you just mentioned is basically to signal that we have completed our basically work, and that the facility is now operationally ready in case any country wants to avail themselves of this facility. Yeah.
Right. Okay, so that takes me to the broader question, and I think something that we all have to think deeply about. The last 2-3 decades have been great for Asia, the reliance on trade and tourism and progressive trade integration and capital flow liberalization. Is the time for growth from those measures sort of run its course? Do we need to rethink the drivers of growth because of all this geopolitical, trade war related headwinds and so on? Or do you still believe in the promise of open markets and trades to carry Asia forward?
Okay, we in our latest flagship report, chapter 2, the thematic chapter, we actually look at the growth strategy for the region, but that was before COVID, right? But it's still, I think our study is quite relevant, and I think the pandemic has basically revealed vulnerabilities in the system, right? The globalization, the disruption to the supply. And so because of the disruption, there's been calls for, there may be there's excessive dependence on this globalized supply chain. And maybe countries need to, insource or reshore some of their production. But I think, and I think there's nothing wrong with that. It's just that the global value chain, has evolved over the years and has become super efficient, I would say. It accounts for 50% of the trade, right, in the global system. And I think that, one can reconfigure the supply chain, to make it more resilient. So, for instance, I think one of the lessons from this pandemic is that you need to diversify, so that if one of your sources get clobbered by a natural disaster or some kind of shock, that you can then rely on other sources. And so we see that, for instance, in Singapore with the food supply, right? Singapore is very dependent on Malaysia for food. But when there was a shortage of eggs, they were able to buy from Poland and Korea, right? So diversification, I think, is the way out, to address the issue of resilience, rather than trying to pull back, and even in the case of medical supply, face masks, PPE. I mean, I think there was a lot of concern that there's too much reliance on China for this medical supply. But the reality is that even in China, there was a shortage of this face masks and PPE in the first instance, right? So I think no country expected this shock anyway. So there will be a global shortage in any case. But then China was able to come out of it, and then they became the major supplier of all this medical supply to the rest of the world, right? So I think realistically, I would say that we should realize that there are some vulnerabilities in the system and try to address it by, preferably by building resilience in the system through diversification, building up reserves and all that. But the system is very efficient, and it continues to be a driver for growth in the world. And many of the countries in the region, especially the developing ones like Cambodia, Laos, Myanmar, they are still leveraging on this global supply chain to grow and and attract investment. So I don't agree that we need to move away from trade and tourism. As talking about tourism is the next big driver of growth in the region. I think we are seeing the emergence of a huge middle class in Asia, and many of them want to travel. And so this is going to drive the tourist industry in many of countries in the region, especially Indonesia, Philippines, which has a lot more potential in terms of growing the industry.
Right. The potential is undeniable. When we can realize the potential, I suppose, depends, number one, on when this pandemic ends and when we have an effective treatment, and after that, how we force the recovery, and of course, how much cost we have to incur to survive till that moment comes. Dr. Khor, thank you so much for your time. We wish AMRO all the best. We need regional institutions like yours to support financial stability, and I think you're playing an integral part. And the same to your researchers coming up with invaluable insights. We're very thankful.
Thank you, Timer. Thank you for inviting me to this podcast. And I hope that we get out of this soon. I think one of the when you talk about tourism, I think one of the most more hopeful development now is the vaccine, which seems to be coming along quite nicely. So I hope that's augur well for the future of the region.
Indeed, fingers crossed for that. Thanks to our listeners also for your time. You can find all our research publications and multimedia by Googling DBS Research Library. The Kopi Time series is available now on all major podcast platforms as well as on YouTube. Have a great day.